All right, good morning and welcome to our next session. It's my pleasure to be sitting down with Marty Proctor, CEO of 7Gen. We're really excited to have Seven Generations Energy here on our lineup again. Certainly one of the preeminent and leaders in Canadian operators, and would like to welcome Marty to the Oil and Gas Conference. Welcome, Marty.
Thank you, Aaron.
Well, let's dive right in. And I know you can do a better job than I. Can you give us a little bit of a high-level introduction on Seven Generations and where you guys operate?
Sure. Yeah, thanks, Aaron. Well, we're the largest condensate producer in Canada. We're a top 10 producer in Canada by BOE per day and a top 5 producer of gas in Canada. We've specialized in Montney development, and we're very focused on the liquids-rich window of the Montney, which is south of Grand Prairie, Alberta. We grew from less than 8,000 barrels equivalent per day in 2013 to average about 200,000 barrels equivalent per day in 2018 and 2019. Now, that phenomenal growth gave us critical capacity and capital markets relevancy, but wasn't sustainable forever. So beginning in about 2018, we converted our strategy from volumes growth to value growth. We worked hard to better understand our rock, and our geoscientists worked well with our engineers to delineate additional resource and improve our type curves. We did all the fundamental science that we needed to evolve our drilling and completions techniques to deliver top wells while minimizing the parent-child interactions. While commodity prices haven't cooperated, every other attribute of our business, everything we can control, has gone well. Our costs have improved, our decline rates are getting better, and we've been generating meaningful cash flow for the last year and a half.
So I want to dive into some of those things, but before we kind of dive a little bit more into the story, let's just stay high level and tell me, I mean, you mentioned condensate. You guys are the largest condensate producer. Tell us what's important about condensate, and also why should investors be looking up into Canada at this time, and maybe some thoughts and perspective there.
Sure. Well, as a company, one of the strategic cornerstones of our company is to secure access to good markets. And so first, we've been very proactive in securing access to good markets for our gas. Over the last several years, we secured access to gas markets in the U.S. Midwest, Henry Hub, at Dawn in Eastern Canada, and at Malin on the California-Oregon border. But as I said, we're a liquids-rich natural gas producer, with natural gas comprising only about 42% of our BOE, and condensate and other natural gas liquids comprising nearly 60% of the BOE. And the condensate market is unique. The best value today for condensate is as a diluent or a mix for heavy oil, a blend for heavy oil so that the heavy oil can be transported. The demand for that diluent is about 700,000 barrels per day locally, and the supply locally is only about 420,000 barrels per day. So that demand and supply imbalance is generally met by imports, which effectively means that condensate gets a price very, very close to WTI. As additional egress gets developed by the Trans Mountain Pipeline expansion or the Enbridge Line 3 reversal or the Keystone XL pipeline, even more condensate will be needed to move that heavy oil. And a final point on the condensate, our condensate is quite different than the import condensate. So ours has a higher density and generally includes quite a bit of distillates. So we actually sell our heaviest condensate into the light oil stream. So as a result, 7Gen has a lot of torque to improvements in WTI, as well as natural gas pricing.
And those are really important components to be thinking about as you think about marketing that product. So I appreciate that color. As you think about certainly a Montney producer, we had our Montney panel yesterday, and we learned a little bit more of what we're calling the Permian of the North. Tell us a little bit about 7Gen specifically, how you differentiate against maybe other Montney producers, and how are investors making money with your stock, even in this type of environment?
Yeah, it's a great point, Aaron. Less than a handful of large E&Ps exist in Canada that have grown to kind of a critical mass that's necessary, I think, to attract investment. We were able to grow the company. We had very supportive capital providers in the early days, first private equity, and then we went public at the end of 2014. We had supportive capital providers who were willing to allow us to outspend our cash flow for a period as we grew the company. I think that's very difficult to do. All of us now are attempting to live within cash flow and, in fact, generate free cash flow. And I would say we gained a lot of experience along the way. It wasn't an easy road. We know now, though, how to develop large-scale Montney assets. We're also mostly liquids rich, as I mentioned, and that's a real key to the economics in Canada. We think we have some of the most economic wells in the country, perhaps even in North America. And now we're uniquely positioned to deliver value to shareholders through free cash generation. We'll allocate free cash flow to debt repayment, share repurchases, or perhaps a dividend even when the time is right. We actually generated almost $70 million of free cash flow in the second quarter this year, probably one of the toughest environments that we've had in a long time.
That's incredible. That 70 million is no short bit of change there. As we think about your evolution, and you gave a little bit of your history, but walk us through a little bit of the evolution of your operations in the play, and more specifically, maybe some of the efficiencies that you've gained, and where does the future of this play go from here?
Sure. Well, as I mentioned, we transitioned our strategy a couple of years ago from growth to more value, and that was what we were attempting to do was get better wells. It was reduce our costs, if possible, get better prices for our products. On the cost side, our drilling completion costs were about $11 million a well 3 years ago, and that's improved steadily. In Q2 of this year, that same well in Canadian dollars is now costing us about $7.1 million. And the wells have generally gotten better as we've evolved our completion techniques, and that allows us to get better condensate recoveries and reduce our parent-child interactions. So we've done a good job, I think, solving the puzzle of developing the Montney resource on a large scale. We've also seen operating costs per BOE go from almost $6 a few years ago to now in the low $4 per barrel over those last 3 years. Our condensate infrastructure investments are behind us as well. Our infrastructure investments are largely behind us. Our gas plants and the pipelines, which give us now more processing capacity than we currently use, and it also gives us the optionality to increase our liquids or our gas percentages. And we've got one of the lowest G&As, one of the lowest general and administrative costs in the business in North America, at about 90 cents Canadian per BOE.
So as you think about the future of where Seven Generations is going, and maybe let's put it into context of cash flow, that 70 number that you just referred to, where would you put that next incremental dollar of cash flow as you're thinking about running this business, and where are there opportunities with that?
Our first priority today will be debt repayment. And so, our debt was the right size for a $50 WTI environment. At the end of last year, our debt to cash flow was about 1.4 times, but it's less comfortable now. And so as we get some free cash flow, we are going to allocating the first dollar of free cash flow to debt reduction. It's a volatile industry, and obviously every dollar of debt reduction should improve the market cap of our business if you assume a constant enterprise value. And this overall de-risking should drive better equity value. In 2 years, we may be similar in production size, but with a mid 30% decline rate, will be even more sustainable, and likely with improvements to revenues net of transportation. We will attempt, in fact, to optimize our take-or-pay agreements over the next couple of years, and that should lead to even more free cash flow generation. So in a few years, I would say, maybe even looking out as much as 5 years, with all those things combined and a combination of sustainable dividends alongside share repurchasing is quite probable for our company, and that should generate good per share growth if the world is still well supplied with hydrocarbon products. We have the asset base to grow meaningfully if circumstances change and prices recover some, but our focus right now is on free cash flow generation, and will be for the foreseeable future.
I want to touch on that inventory in just a minute, but let's stay on the subject of capital investment and returns. Walk us through a little bit of how the economics are across your portfolio, and how does that change as commodity prices move up and down across your portfolio?
Sure, it's a great question. We've got a lot of detail in our corporate deck, and I'd encourage the readers or the listeners to go and have a look at that. But many companies talk about triple-digit rates of return, generally on a half-cycle basis. We actually generate very good rates of return on a full-cycle basis as well. Our average wells on a full-cycle basis, even at $40 WTI, 250 gas, maybe a $3 condensate differential, we have about 40% IRRs at those prices even. And as I said, again, that's on a full-cycle basis. And so that means we'll have a very good return on capital employed for each new dollar of investment. And that includes infrastructure, G&A, and our single well numbers do look great, but few can say that, I think, on an all-in basis. We have three core regions which allow us to tilt our commodity mix to respond to changes in gas prices versus condensate prices or WTI prices. And in a $40 WTI 250 gas environment, our gassier Nest 3 region is actually preferred probably for capital. And we have the infrastructure available now. We actually completed a large pipeline to connect that Nest 3 area to our core area last year. We have the infrastructure in place that we can add more gas to our mix. Our expectation, though, is that commodity prices will shift in favor of oil again and condensate. And so we're in a very good position to take advantage of that as well.
So as you think about your production and certainly having free cash flow, one of those important metrics and that a lot of folks are tied into right now is what level of spending do you have to put back into the ground to hold your production flat? Can you give us a little bit of a lens into what that looks like for you all?
Yeah, it's a great question. In fact, we learned a lot about this year. We had set out with a production forecast of about 200,000 BOE per day, essentially flat to last year's production, and a capital program of $1.25 billion. As commodity prices collapsed in the end of the first quarter, we decided to adjust that program, and we shaved 41% off of our capital budget, taking it to $650 million. And we shaved about 11% off of our production forecast, taking our full year forecast to be about 180,000 barrels equivalent per day at the midpoint. And as we recognize that our costs are improving and declines are mitigating, we see that we can stay flat at that new level, that 180,000 barrels equivalent per day, with capital consistent with about this year's level. So next year, for 650 to 700 million dollars, we expect we could stay flat and going on into future years as well. To get a little more detail, it costs us about $10,000 per barrel per day to grow our production, or to add production, really. And with our corporate decline where it is now, that means we're having to replace about 65 to 70,000 barrels equivalent per day of production. That then leads to those numbers that I quoted, the 650 to 700 million to stay flat. But over time, that improves as we get more decline moderation. We actually think our decline rates will be in the mid 30s by about 2 years from now, middle of 2022. And we also anticipate additional cost savings that will further enhance our ability to stay flat for less capital and therefore have more free cash flow available to our shareholders.
And that's great color. As we think about that ability to hold production flat, certainly, there's an inventory question, and I wanted to jump a little bit into your inventory and your ability to either ramp up or stay flat. How do you think about that inventory number? What does that mean for you guys? And maybe another question is, when do you add a rig or take away a rig as you start thinking about that development plan?
Yeah, another great question. And as I said, about 2 years ago, we began our transition of the strategy, and that included doing fundamental science, understanding the reservoir. It also included an allocation of some capital to more delineation. So, for example, last year, we added more upper Montney locations in the Nest 2 region than we actually drilled. And our work in the lower Montney has proved to be much better than expected, in fact. And so we've been able to add top-tier drilling inventory over the last couple of years as we've allocated capital away from just the previous allocations, which were largely in the Nest region. Maybe to expand a bit too on the lower Montney, as I said, it's better than we had expected, and as a result, we we are actually seeing some lower Montney results, particularly in the southern S3 region, that have been better than the upper Montney results. So that's been good. It's added to our inventory. We think we have about, in fact, our reserve evaluators also see about 1,300 nest quality locations in the upper middle Montney only. And there's well, the lower Montney exists everywhere that the upper Montney exists. So we think there's a lot of inventory in the upper Montney. And so that is a long life. We're talking about several decades of top tier inventory. And we expect that through more delineation, we're going to add even more to that. And that hasn't even talked about our areas outside of our core or outside of our nest. We have a lot of inventory in a region we call Wapiti, which is near some great development by another operator, New Vista. It's an area they call Bilbo, but has a lot of locations for us as well. So a lot of inventory available for us to develop. The final part of your question is, when would we allocate more capital to additional drilling? At the moment, as I've said, we're very, very focused on just generating free cash flow and optimizing our field development, reducing costs, taking advantage of the mitigation of decline rates, and therefore generating free cash flow. Ultimately, we need to have a business that generates free cash flow that we can and will give back to our shareholders.
And taking that one step, maybe a little bit, you mentioned the upper and the lower Montney. What are you guys doing? Where is your focus on upper versus lower, and where is there more maybe work to be done here in the near term to delineate some of that acreage for you all?
Yeah, it's a great question. And as I said, it's only been in the last couple of years that we've actually allocated some capital to that lower Montney. And my belief now is that the best building block for our development will be a triple stack, where we'll have wells in the upper, wells in the middle, and wells in the lower. And you can think about it, I mean, even though I've said in some areas our lower produces better than the upper, in some areas it's not quite as good as the upper. But you can think about the lower development as being nearly half cycle if the upper is essentially carrying the cost of surface infrastructure and some of the facilities we need to process the products. The lower then can tag along for just drill and complete costs, essentially, with a small tie-in component. So the economics of the lower, even if the results aren't quite as good as the upper, the economics of the lower can be very, very attractive as an increment to the upper. So I think our building blocks will become a triple stack, and that's the tilt that we've had over the last year and a bit, and will probably continue for the foreseeable future.
Well, I think that's helpful to also be thinking about this play in the multiple layers, not just the geographic space, which you certainly have a lot of acres there too. So let's talk about, we can't seem to have one of these discussions without having the topic of consolidation. And certainly there's belief that there's going to be more consolidation. Where do you guys sit on that, and what benefits, one way or another, could 7Gen have from more consolidation in the industry, and then you guys specifically?
Yeah, and another excellent question. And we're always looking for ways to make our company better. And we see the potential benefits of consolidation in the Montney, particularly with respect to, I think, the primary objective being accelerating and enhancing the capacity to generate free cash flow. And also, I think a corollary benefit would be to just increase the size of the entity, hopefully qualify for a better credit rating, get to investor grade status if possible. That then may allow a lower cost of capital, certainly lower interest rates on any debt that we may carry. So there are those opportunities, and we are open to considering it if it's in the best interests of our shareholders and stakeholders. I think that people often have looked to us, they see us to take a lead role here, in part because of some of what we've talked about already. That is the fact that we're one of few operators with a large, high quality asset base and full field Montney development experience. And we've been very, very successful in improving the way we work, generating very good quality, very high return wells, and also reducing our costs, therefore getting to the point where we can generate free cash flow. And as I mentioned earlier too, we have one of the leanest cost structures, including our G&A in the business. And I think becoming more and more important is the fact that our environmental stewardship is best in class. So as I said, we're open to M&A if it's beneficial to our shareholders and our stakeholders.
Well, you led right into my next question, and we can't have a topic of discussion on 7Gen story without what I believe is one, the Canadians have led this ESG kind of story in oil and gas. And then even within Canada, 7Gen stands out. And so I wanted to dive into this environmental, social, and governance. It's certainly more than a trend. And talk a little bit about how you guys think about that internally and how you live and breathe that, but also what you guys are doing along those fronts.
Yeah, thanks, Aaron. It is very important to us. And even back when the company was founded, the name of the company, Seven Generations Energy, it's a sustainability concept. It's a name, it's a concept that we borrowed from the Iroquois First Nation. They had always said that when you make a decision, you need to consider the impact of that decision on the seventh generation. That thought, that way of thinking, I think was very progressive at the time of us founding this company, and it persists today. We have what we call our guiding principle, which defines our seven key stakeholders. And we see our purpose as being serving the needs of those stakeholders, which of course includes our capital providers or our shareholders, but also the community where we work, government, people that we work with, our business partners and service providers, our employees. But as I said, community is very, very important to us, and will continue always. And I think also it's worth noting on the ESG front, we have always had a push towards minimizing our environmental footprint. It goes to the way we have designed our super pads. This triple stack is done in a, well, pseudo cube style, you could say, but it's done in a way to minimize our surface footprint. We've also worked hard to minimize our emissions. We were one of only two companies in Canada last year to receive an A- rating from the CDP, formerly called the Carbon Disclosure Project. We have on the G side, we have a fully independent board. We have an independent board chair. We've been very focused on performing in every ESG capacity, and we've made good progress on it. And one of the things we're getting better at is not just performing well and improving how we perform, but also improving how we report.
And so one of the things, and certainly we'll stay a little bit here on the ESG, but one of the things that we've seen a lot of our companies actually be highlighted now is the S. And in this COVID era of running a company, can you explain a little bit on how you're taking care of your employees and how are operations maintaining in maybe this remote environment?
Sure. Well, we've all learned a lot through this, and the first priority was ensuring the safety of our workers and the public that may be near us. And so I would say I'm actually really proud of how our team has responded to this new environment. As soon as recommended by public health authorities, we went to a remote working situation. So anybody that was in the office went to work remotely, generally from home. And we implemented a lot of new protocols and procedures to keep our workers in the field safe. We implemented a lot of hygiene procedures in the camps. And touch wood, we've had very, very little impact due to COVID. But I would say that the focus continues. And we have learned a lot through it. And I think we may look at evolving our business model in the future that can accommodate a little more remote working environment. But to give more specifics too, I would say, the first thing we did, as I mentioned earlier, in response to COVID, which impacted supply or demand for oil, therefore big oil oversupply, therefore commodity prices collapsed, is we very smoothly reduced our capital investment. So from a period from mid-March to the first couple of days of April, we shut down and parked 8 drilling rigs, and we shut down and parked 2 pressure pumping spreads, and therefore reduced our capital investments until we could see some clarity around where prices were going to settle. And the team did a great job in managing that, the suspension of operations and suspension of, the suspension of drilling and completions activities while continuing to produce our wells in a very optimal way. So we've responded, I think, extremely well. Safety of the employees was paramount, and I'm pleased with how everybody has done in that regard. And we'll see if there's opportunity here to make some lemonade out of all these lemons that have been pelting our business. And I think we probably come out of this even stronger.
And I love that color, and when we're thinking about this, when I'm talking to other executives, I think there's some things that we have learned out of this environment that we're going to carry forward, and it'll be exciting to see what the next oil and gas company really looks like and where we're moving on that. I wanted to touch one last bit on you talked about pricing, supply and demand. One of the other fundamentals that you talked about reducing capital expenditures. Walk us through a little bit on some of your thoughts on the hedging program, and do you guys have an active hedging program, and do you have things that you're looking at as markers for you all as you're going through that?
Yeah, another great question. And it is part of I had talked at the beginning about our cornerstones of our strategy. The first is stakeholder service, as I mentioned. Second is having that financial strength, market access, and really having the low cost of supply, ensuring that we get the best wells for the lowest cost. So all that is important to us. And the focus continues. On the financial side, the hedging question that you asked, we have for years had a very disciplined and very objective hedging policy, overseen by our board, of course. But the intent has generally been to have about half of our first year production hedged, about a third of the second year production, and about a quarter, well, in fact, between 10 and 15% of our third year production hedged. And so we entered this year in a pretty strong hedging position. As commodity prices collapsed, we actually added some hedges. We were able to find a way to put some hedges on, kind of on a calendar month average basis, as opposed to kind of contract traded basis. And therefore, we had some very good protection. And hedging contributed quite a bit to our Q2 results. We will continue to do that. We have this hedging policy, as I mentioned, with the graduated levels of targets for hedging over the next 3 years. We'll continue to put in hedges in that way. As we look forward and we see, I think, gas prices at a reasonably attractive level, we are adding some gas prices or gas hedges, probably in the middle of our target range. We still see a likelihood that WTI improves from here, and so over the next couple of years, we're actually probably on the low end of our target ranges for WTI hedges. But we will continue to put hedges on. As 1 quarter rolls off, we're putting hedges on 3 years from now, 12 quarters out. So we'll keep that practice to help to ensure our financial sustainability.
That's great. And Marty, just kind of one last question here that I wanted to throw out, certainly very open. What is it that you want investors to take away, particularly down here in the United States, from this presentation, our discussion, and where you guys are headed?
Sure. Well, I think this, as you say, there are several highlights, I think, to the presentation that we attempted to make here. First is that the Montney is a very high quality asset base, and we have a great position in the Montney, 500,000 net acres, about 800 sections of Montney in what we think is probably the best part of the Montney, the liquids rich region, as I say, about 100 kilometers south of Grand Prairie. So we have a very good asset base. I think another key for us is those strategic principles, and that is making sure, one of them being making sure we have the lowest cost of supply. So delivering good wells, doing it for a very good capital price, hopefully bringing those costs down, having all other costs contributing to free cash flow generation, and therefore having some of the best economics in the business. And I think the third point I want to highlight is that we have transitioned our business from growth towards free cash flow generation. We want to make this a compelling investment for shareholders. So first, predictable returns, and also good returns. And it is our intent to generate good returns and give those to the shareholders.
Well, Marty, thank you very much for that. I really do appreciate you being here. Certainly encourage anyone who's got additional questions for Marty and the 7th Generation management team to schedule a one-on-one, get more information. And Marty, thank you again. I appreciate it.
Thank you, Aaron. I really appreciate the opportunity to be here at the Intercom conference. Thank you.